Brad Williams, Frugal Finance, 30-year Treasury bond. Calculate the yield to maturity. Let's break this down. You have a 30-year U.S. government bond that originally had an interest rate of 7.5%. However, the current market is 7.75%. To understand the value of the bond, we need to consider how much money you'll receive from it over the 30-year period compared to what you could get from other investments at the current market rate. 7.5 versus 7.75. What's going to happen when interest rates increase? Your 30-year bond, if you were to sell it immediately at the current market rate, is going to lose value. Why? More people are interested in 7.75 investments. Why would they buy your bond at 7.5 when they can go next door and buy it for 7.75 with no additional risk? What happens? You're going to take a haircut. Let's say it's a $1,000 bond. What's going to happen? Well, the price is going to drop in order for you to be competitive. How do we compute that? Each year, the bond pays you $75 in interest. This is because the bond's face value, also known as par value, is $1,000, and 7.5 of 1,000 is $75. But in the market, with the current rate of 7.75, you could get more money for your investment. The bond value decreases because it's offering less interest compared to what you could get elsewhere. This decrease is reflected in the bond's market value. The table shows how the bond value changes over the years. At the end of the 30 years, if you receive 75 every year from the bond, its value would be $971.18 today. That means if you sold it today. If you hold on to this for 30 years, this is a moot point. Doesn't mean a darn thing. If you receive $37.50 every 6 months, because some bonds pay interest twice a year, its value would be $987.62. In other words, the bond value decreases because it offers lower interest compared to current market value. Here is the value. Here's the value, 987. How do we do it? Well, here's a table. Notice there are hidden rows here, 37, then we go to 82. We just went over 60 periods, so they're semi-annual payments. You can see what happens here. And then we have semi-annual and we have annual payments. And I just played around. And you can see this is on an annual. There's your 971. And then there's your 987.62. The yield to maturity, we've got a new price, 987. 971.18 is the value. And the yield to maturity, here's the layout. This is the information you need in order to compute the yield to maturity. The formula, you can just follow this right here. Certainly you ask, Brad, there's got to be an easier way to do this other than setting up this chart. There is, and I'm going to show you that next. Here are the statistics. We have a face value of $1,000. We have an annual coupon of 7.5%. Semi-annual 375. All we're doing is taking that divided by 2. 29 years left to this deal. Number of compounding periods 58. Annual coupon is there's 75 periods, and divide that by 2. This is going to be just the number here, here, and here. Anyway, we're going to plug and chug. Here's the formula. If we need to go back up here, it's not shown. So we have, just go with this. Yield to maturity equals coupon plus price minus new price divided by years to maturity divided this price plus new price divided by 2. That's it. This is what it looks like. So you can plug and chug. Here's semi-annual and annual. That's it. Here is just the structural means of calculating the yield to maturity, and then here is the shortcut. And then you can use the price function within Excel to do this, and we will as we move forward. Brad Williams, Frugal Finance. See you soon.